Did you know that in just the last year, the Federal Reserve raised interest rates 7 times? That's a staggering move. But what does that really mean for the stock market? Stick around, because we're diving into how these Fed rate hikes impact your investments and what you need to know to stay ahead of the game. Hey everyone! Welcome back to the channel. Today, we're tackling a hot topic that's on every investor's mind: Fed rate hikes. If you've been following the news, you've probably heard about how the Fed's decisions can shake things up in the stock market. So, why should you care? Well, understanding these rate hikes is crucial because they can affect everything from your investment portfolio to daily expenses. We're going to break it all down today, so you'll know exactly what's going on and how to navigate these changes effectively. Let's jump right in. Alright, so let's get into the nitty-gritty. What's the real challenge with these rate hikes? When the Federal Reserve increases interest rates, it generally leads to higher borrowing costs for consumers and businesses. This can cause a ripple effect that brings down stock valuations. Imagine you're a company looking to expand. If borrowing is more expensive, you might hold off on that new project, and that means lower potential profits down the line. Investors start to get anxious, and uncertainty creeps in. Now, think about it. If interest rates go up, investors may find safer investments, like bonds, more attractive. Why? Because they can get a better return with lower risk. This shift can lead to a decrease in demand for stocks, pushing prices down. Plus, higher rates can signal that the economy might slow down, which is definitely not great news for the stock market. So, we've got a situation where higher interest rates can lead to lower stock prices and a lot of investor jitters. Not exactly a fun time for the markets. Now, let's take a step back and explore the historical context of Fed rate hikes. If we look at the past, we can see some clear patterns. For instance, back in the late 90s, the Fed raised rates several times as the economy was booming. Initially, the stock market continued to climb, but eventually, those hikes contributed to the dot-com bubble burst. Fast forward to 2008, and we see that when the Fed slashed rates to fight the financial crisis, it helped stimulate a recovery in the stock market. So, what influences these decisions? The Fed looks at various economic indicators, like inflation, unemployment rates, and overall economic growth. When inflation is high, they might raise rates to cool things down. Conversely, if the economy is sluggish, they could lower rates to encourage spending and investment. This balancing act can significantly impact investor sentiment and stock performance. Understanding these historical examples and economic factors gives us a clearer picture of how rate hikes can affect the stock market today. It's not just about what's happening now, it's also about how history can inform our expectations for the future. As investors, we need to keep an eye on these trends to make informed decisions. Here's the big insight. While rate hikes can lead to short-term volatility in the stock market, they don't always mean a long-term downtrend. Many experts point out that if the economy is strong enough to handle these hikes, the stock market can recover and even thrive. For example, after the last series of rate hikes, we saw some sectors adjusting and finding ways to adapt. The tech sector, known for its resilience, often bounces back quicker than others. Market reactions during significant rate changes are crucial to watch. Investors tend to react based on emotions and news, which can lead to short-term swings. However, seasoned investors know that it's essential to focus on the fundamentals of companies rather than just the noise of the market. So, yes, when the Fed raises rates, it can spook the market momentarily, but it's also an opportunity for savvy investors to find undervalued stocks. To wrap things up, we've talked about the impact of Fed rate hikes on the stock market. Higher interest rates can lead to lower stock valuations and increased uncertainty for investors. But history shows us that markets can adapt and recover, especially if the economy remains strong. It's vital for investors to stay informed and understand these dynamics so you can make the best choices for your portfolio. Remember, knowledge is power, especially in times of change.